Welcome back to Business Talk here on Business Tech. Effectively, the nominal repo rate is at its lowest level in 48 years in South Africa. The last time we had to lower interest rates to this level was during the Yom Kippur War and the oil crisis of 1973. And back then, the policy rate stayed below 3.5% for less than 90 days, though, before going to 3.78% and higher in a very short space of time. So we are indeed living in very unique and interesting times. And this interest rate is playing a starring role in the surprisingly good numbers we've seen from consumer-facing companies recently. Well, to find out more about how the state of personal balance sheets is looking post the pandemic, or as we exit the pandemic very slowly with our vaccine rollout, I'm joined by Dries Zietsman, Head of Financial Services at TransUnion. Dries, welcome to the show.
Thank you, Michael. It's good to be with you today.
And TransUnion, I've really been looking forward to this because you've got a strong data set of consumer finances that you can draw on to help us really tease out and understand the health of the South African consumer in the wake of the pandemic. Can you just give us a brief overview of the financial impact of COVID-19 on consumers so far?
Yeah, Michael, it's it's true. We've got, we track consumers across multiple aspects. We started tracking consumers at the beginning of the pandemic last year to really understand, what the impact of COVID will mean to consumers' financial well-being. As last year was quite a rough year. We had severe lockdowns in the retail space, as an example. SMMEs got severely impacted. As a result of that, many job losses, reduction in working hours, and we saw consumers being, quite under pressure. The last survey, though, that concluded at the end of March this year, is giving us some positive trends, which is really positive for us. We're seeing that 8 out of 10 consumers at the moment are indicating that they are quite optimistic about their financial health, and half of that population actually believe that they would be, fully recovered within the next 12 months throughout this process, which is quite positive. Now, if you look at this a little bit closer, you would find that 62% of the surveyed population still indicated that they are financially impacted by COVID. Now, it is still a good news story, because if you reflect back to, for example, the December number, we were sitting at roughly about 82%. So that gives you a 20% improvement in just customer perception. The reality, though, is when you start looking at that 62% of consumers more closely, those consumers are impacted more. So, for example, 87% of that population is impacted and really concerned about the fact that they may not be able to service their current debt obligations, compared to 83% in December. So there is a slight increase there. And similarly, so we've also seen 37% of that population, really concerned about being able to make their payments in the coming weeks.
And within that, how are consumers managing their budgets in the wake of the pandemic? I'm sure there are specific line items, things that they could probably do without, that we're starting to see being cut from the household budget every month. What is the data telling us?
So again, when we look back at 2020, consumers obviously felt the pressure. We have seen, the financial industries coming to the party with, payment relief programs during, the difficult times. We've also seen some extension of some of those payment relief programs, throughout the industry. But the unfortunate reality is, that has come to an end. And moving into this year, consumers are absolutely aware that discretionary income needs to be managed. And there's a really good sentiment that's coming through in the numbers, where people are in fact looking at, paying obligations that is critical to their livelihoods. What we have seen is about 74% of consumers are currently, really cutting back on discretionary spend, and that is, the extra money after you've serviced your debt obligations, to making sure that they've got, some monies available for when it's needed. But at the same time, You see, consumers making decisions to cancel subscriptions, 42%, and that could range anything from gym, subscriptions to, possibly magazines and stuff that they may not need. So definitely a focus from consumers to make sure that, the monies that are available are spent most appropriately.
Yeah, and it's an interesting one on subscriptions, because on the one hand, I think intuitively you would think things like maybe a DSTV subscription might be cut. On the other hand, because of COVID, our entertainment options are limited in terms of going out or gathering in large numbers, going to the cinema, for example. So maybe consumers might be saying, well, if I'm not going to be doing that, I might hang on to the DSTV for a little bit longer. Where do you see the priorities, and where are consumers ensuring that they're not falling behind?
Michael, it's an interesting question, because, you have to go and look at this from a demographics point of view, and especially, when you start looking at the population in terms of generation allocations. So, for example, our Gen Z, 0 to 25-year-old population, we see, quite interesting enough, the numbers show us that even the debt obligations that they have has reflected no real impact during this time. And, it leads you to, understanding this a little bit in more depth. And when you get into the numbers, and, it is very clear that a lot of the Gen Z, population is still serviced through, living at home with their parents, which obviously, falls within the Gen X, population, which is 41 to 55-year-old. And, with having that savings and, that support helps that population. When you go to millennials, as an example, it's very, very different, because on an income earnings scale, millennials are not quite where the Gen Xers are, but at the same time, you would find that millennials don't have the same obligations. They don't have the big home loans and, car financing in all cases, where, in the Gen X portfolio, the debt obligation in terms of big secured financing is far greater. So there's not a simple answer to that question. I suppose it depends on the demographic. If you do not have the big home loan and, car finance to cover, then maybe, it becomes a lot more flexible in terms of playing around with subscriptions. What do I take and what do I keep? But your point is really relevant from the perspective that, COVID and the lockdowns, especially during last year, has brought to the fore a big change in consumers, right? So being at home, being restricted on movement, has seen a massive spike in digital. Yeah. And as a result of that, you also see a significant growth in utility utilization. So, when you talk about, products, lending products as an example, credit card is something that has really come to the fore, because if you think about online shopping and, ordering stuff to be delivered at your home, the only way that you can really do that and facilitate that is through a credit card. And therefore, the behavior on a credit card is very, very different to what you would see on any of the other products that we see in the market.
That's fascinating. It ties through to what I was chatting to Tiger Brands about not too long ago. We're seeing a big uptick in their snacks division. Why? Because people are staying at home, they're watching a lot more Netflix, they're snacking, and that's been a big boost to their business. So we're seeing this changing consumption pattern and behavior, and very important for businesses looking to tap into that consumer market to really understand how this might play out into the future. I want to zoom in on the credit card issue, though. I think intuitively one might think that we're seeing applications for personal loans increase because of household stress. What are you seeing in the data? Is it maybe the other way around? Is it that consumers don't want to take on any debt at the moment? And the private sector credit extension numbers make me think that it's probably the latter. But what can you tell us at TransUnion?
Yeah, Michael, again, there's so many nuances in these numbers, because, at the end of the day, when you start looking at it closely, credit card as an example, really comes out the top alongside, vehicle finance and home loans. And maybe to just give you a little bit of more insight, we run a separate survey called Payments Hierarchy at TransUnion. And basically what the survey is about is we look at consumer behavior in terms of where they would spend their income first, right? So what debt obligations do you choose to pay? Now, quite interesting enough, home loans are being serviced, consistently. You see vehicle finance had a bit of a blip, but, it's being serviced consistently. But credit card has really gone up the ranks, to our earlier conversation, because that utility benefit that it provides is quite important to consumers. And also, a credit card is a revolving facility. So if you pay X amount onto your credit card today, it is available immediately. Now, on a personal loan, that's not quite the case, right? A personal loan, you get paid out, a sum of money at one point in time, and you have to obviously, repay that balance over an extended period of time. Now, again, on personal loans, you get bank personal loans, you get non-bank personal loans that's funded through fintechs or retail, etc. Now, when you look at the two portfolios independently, in the personal loan space, we sit with almost 6 million personal loans issued in the market at an average balance of roughly about 43,000 Rand. But if you go into the different portfolios, you would find that in the banking sector, personal loans are usually much larger in value. And also the term is extended, 24 months plus. Whereas if you go into the banking personal loan market, it is different terms. So shorter terms, there's a big demand in the industry now for short-term 0 to 3 month personal loans, which has not really always been serviced, at an industry level. So that product has not whilst it's been available, it wasn't one of the top products that's been pushed, but the consumer demand for 0 to 3 months has absolutely increased, and it's opened a very unique opportunity for fintechs to play within that space. So just coming back to the payments hierarchy, what you would find then is that at the bottom of this payments hierarchy, people choose not to pay certain debt obligations. If I need to make a call, I don't have enough money to pay all of it, what won't I pay? And what you do find at the moment is that 39% of consumers have indicated that they would more than likely do partial payments where they need to. But if you go down into the detail, informal loans, 46% of consumers said that they won't pay their informal loans. Personal and student loans, which falls very much in that, personal loan, category, 44% of consumers indicated that they won't be paying those loans. And then retail and clothing accounts, obviously, also very high on the list at 40% of consumers saying that they won't pay that. So if I need to choose, do I pay a personal loan or a retail clothing account, or do I pay my car that I need to generate income? Yeah. So that is some of the trends in the behavior that we are seeing in the industry.
Yeah, very interesting. So average personal loan amount then around 43,000 Rand, obviously stratified through the data as well. Just whether or not you see kind of more applications or fewer applications within that, can you just give me a sense of whether or not banks are lending again based on the number of applications that you're seeing and the number of applications that are actually approved?
Yeah, absolutely. Michael, last year during the crux of COVID, there was definitely, more of an increased risk averseness from, the banking and retail sector around, credit extension into the market. Risk appetite was definitely subdued. One can appreciate why, when we look at, what the collection strategies and the impairments look like in terms of what the industry needed to write off for debts that were unpaid. There's a balance between, extending credit and making sure that, it's good credit, that will be paid from a financial services perspective. So moving into this year, account origination across the industry has opened up. Has it opened up back to a normalized position compared to what it was previously? Not yet. But, again, it depends on the product, so personal loans, specifically to your question, has personal loans opened up? Yes, it has opened up. Is it the same as what it was, pre-COVID levels? Not yet, no.
And within that, I suppose, is a question around whether or not we are seeing the crisis impose a certain discipline on consumers. Are they approaching their finances in a way that they've learned lessons? They've become a little bit more savvy with their money, perhaps make sure they've got an emergency fund before they take out a loan for something that they might need immediately. Have we learned anything from the crisis?
Yeah, there's two very interesting comments for me to make around that. I suppose the one is that, savings behavior across the industry and, for many, many years has been a very topical item, that's been discussed, and why we're not seeing the saving behavior. And what COVID has brought to the fore is consumers really realizing and appreciating the importance of having savings available for the day when you need it. Now, we surveyed this as well to understand, where consumers find themselves. And 99% of consumers have indicated to us that savings have absolutely become more important than ever before, and that they would continue to drive savings, could they or should they be able to do so. Now, again, when you dive a little bit deeper into this, it's quite interesting because there's always deterrence within a good trend or in a behavior. The fact that I may want to save doesn't mean necessarily I can save. And what consumers have indicated to us is, one, insufficient income. Obviously, when your salary is not big enough, given your obligations, 61% of consumers indicated that that's one of the main reasons why they will not or cannot save. Unexpected expenses and emergency expenses coming in at around 40%, things that they've maybe not, counted on or expected to come through. But what is more interesting for me, Michael, throughout this process is that, credit is important, and consumers have indicated to us also that, and to the level of about 67, almost 70%, of consumers indicated that they considered applying for credit now, allowing them to service their debt obligations. Now, it is important that, when you take the 70% of consumers that want to apply that have not applied yet, why they have not applied yet is cost of credit. I think, consumers are becoming a lot more financially savvy in understanding the cost of having credit available to you, with 26% of consumers giving that as a reason why they haven't yet applied for credit during these times. Similarly, 32% of consumers indicated that they will not apply because they know that their application will be rejected. Again, indicating that the financial savvy and understanding is coming through, because if you understand your credit rating and you understand how credit is extended in market, you can automatically make those assumptions. So you see that coming through, which is really positive for me. And then 25% referred to their credit history, which is also a good thing, because it shows that people are becoming a lot more focused on managing their own individual credit records, and tracking that on a continuous basis.
And that's so important, because if you manage it well, you bring down your personal cost of credit, and there is good debt. I mean, if you can borrow and invest in an appreciating asset that grows greater than your cost of credit, that's good debt. I mean, debt. I hate in the financial media when debt is just sold as the boogeyman. All debt is bad. It's a lot more nuanced than that. And it's great to see that the consumers are realizing that. Just lastly, I see data from TransUnion also shows that during desperate financial times, obviously, people often resort to desperate measures, and it obviously opens you up to scams, things that are almost too good to be true. That's generally the first sign. If it sounds too good to be true, it is. Just how big of an issue is this becoming, and how many people are falling for scams that many think they'll probably never fall prey to?
Yeah, that's a very, very relevant item at an industry level at the moment. And you can appreciate, as per our earlier conversation, this migration towards digital. Digital fraud scams are becoming more and more relevant. A lot of people are new to digital and online shopping and those type of things. And it creates an environment for people to be, quite vulnerable. Now, we also just spoke about, people spending more time on the reviewing their credit reports. Now, what is quite interesting is 41% of consumers feel that it's extremely important to continuously, check in on your credit status and your credit reports. And why is this important? Not just to manage your credit, but to see if something has happened on your personal profile that you're not aware of, because, those individual line items are reflected to you. So if something happened, and your, personal information was stolen at some point in time, you would see it reflect and come through on your credit record, and then obviously you can act on it. But, main reasons that's coming through: 44% protect against fraud, and obviously, that becomes quite relevant. And amongst the, the people that's being targeted with regards to, these scams, you would find that unemployment-related scams are, at the top of the list at 29%. We would see, phishing scams where they want to get your personal information to go and act on at 28%. And then third-party seller frauds, especially within digital, and online websites is coming through as a top item as well. So, definitely people need to be very aware and keep track of what's happening in the online space.
And go and visit Have I Been Pawned? I was chatting to the founder, Troy Hunt, recently, and it's amazing. You type in your email address and you can see if it was involved in any of the data breaches that have really happened in the last decade. And you may think you've been immune, but there could be that one app that was a health and fitness app you downloaded 4 years ago. Well, there it is. It was part of a data breach. And so your information is sitting there potentially being sold to a scamster who's going to try and get you with a phishing email or something like that. So very important advice there. Dries Zietsman, Head of Financial Services at TransUnion, thank you very much for taking us on a tour through the COVID consumer here on Business Talk. Take care.
Thank you, Michael. Thank you very much. Have a good afternoon.